Okay, welcome back. In this and the next couple of lectures, we are going to start to delve more deeply into the idea of risk. Right now, it's something we've avoided for the most part throughout the rest of the class, the rest of the lectures. We've always just assumed, for instance, a discount rate, and that's because we really wanted to get a good handle on all the other financial concepts before we tried to understand how risk plays into finance and into all the concepts that we've talked about so far. Okay. Now, I've said this before, and I'll say it again in later lectures, but I really want to reinforce the idea that when we talk about risk in finance economics, we're talking about a different concept than maybe the one that you have in your head when you think about risk, right? So, in the colloquial sense, meaning in everyday language, when we talk about risk, what we're really talking about is downside risk, right? We're talking about the negative outcomes that might happen if we undertake a certain action, right? So if we think about the risk of, say, going skydiving, which is the example I always use, then of course what we're all thinking about the risk is that, oh, it turns out they gave us a backpack instead of a parachute, and we go, right? We don't think about the fact that the other outcomes of going skydiving are that we'll have a fantastic time, and maybe we'll change our life and quit our job and go skydive for the rest of for a living. That is also a potential outcome, and there are tons of other potential outcomes. We might just have an okay time. We might not really like it because it was too scary, but we didn't hate it, and of course we didn't die. We might have a great time, but not a time not so great that we decide to quit our jobs and just become a skydiver, right? So there's a whole range of potential outcomes, and in finance and economics we borrow the idea of or we borrow our definition of risk from the statistical idea of variance, right? And the variance is the variability, the potential range of outcomes that might occur given some potential action. And so when we talk about risk in this class, in any other finance and economics class, and in all of our lectures up to this and going forward, what we are talking about is the potential outcomes that might occur given some action. And so the risk of investing in a specific stock or in the stock market is, also goes from we lose everything to we make everything, and every potential outcome in between. And so we need to keep that in mind when we talk about risk. Okay. Reframe the way you think about the word risk so that it isn't just only negative outcomes. Okay. Now, what our goal is to move towards creating a framework or a model that can help us understand how risk and return trade off. Okay. So that's where we're headed. In this particular lecture, we're going to spend more time talking about the history. We're going to talk about sort of the logical steps that get us to the model that will really cement in the chapter 13 lectures. Okay, so 12 and 13 are really tied together. Then after chapter 13, when we hit chapter 14, that's where we'll start to try and put this model that we've developed into a bigger context and apply it to, say, companies and projects and things like that, right? So how do we turn this model that we've talked about into something that we can really use and practice? Okay? And so in this particular lecture, we are going to start by talking about returns, right? And hopefully that's not too out of the blue for you, because we do understand, or hopefully you remember, that one of the fundamental rules of finance is that risk and return have a trade-off. Okay, so we're going to talk about returns. We're going to talk about historical returns in the stock market, and how we and the reason we want to do that is because looking at past data is the best way we know to try to make inferences or predictions about future opportunities or future occurrences. We're going to talk about different kinds of mathematical techniques to estimate averages and to estimate variance, which is our measure of risk, right? So these are both borrowed terms from statistics, and we're going to talk about their introduction here, and then we will refine that technique in chapter 13, and that's where we're going to do more of the math, more of the problems, more of the working. So in this chapter, we're not going to work a lot of problems. We're not going to really work any problems. We're just going to talk about technique and the goals. Then we'll talk about average returns and sort of the historical stock market history, and we're going to do some talking about what's called efficiency and efficient markets. Now, the first thing that we want to do is think about financial markets, right? Now, financial markets, the term or the idea of financial markets incorporates a wide variety of possible markets, right? So we could very well be talking about the oil market. That's a financial market. We could be talking about the bond market, which we've done a lot of talking about. Stock markets, which is where we buy and sell stocks on different markets all over the world, all the way to commodity markets. Oil market is a commodity market, but there are specific exchanges, centralized markets for nickel and silver and gold. There are exchanges for tulips and for grain and for animal products. There are financial markets for cryptocurrencies and for land and for you name it, we can create a market for it, right? So we are trying to build a framework that's broad enough to incorporate the idea of risk and return within the context of all of these markets, not just stocks or bonds, but we have the most data and the most available data, the longest history of data, mostly with equity markets, stock markets. So that's where that's the kind of data we're going to use to develop our framework. And then hopefully we'll understand that, or we'll find out that we can still extrapolate this technique or these models or this framework to any other market. Okay. So we want to start by thinking about what the goal or the importance of a financial market actually is. Okay. And if you sat there and tried to think about it for a little while, I just kind of want you to do that. Maybe hit pause and just be like, what's the goal of a financial market? What does it really mean to the investor, to the company, to any participant in the market, right? And maybe you come back and you think, well, the goal of, say, a stock market is that an investor can put money into a stock, they can buy a stock, and hopefully the value of that company will grow, and so the value of the investment will grow, and the investor will increase their wealth, right? And because stock markets are probably the most familiar financial market to most of us, that seems like a pretty viable goal. And you could think of, other goals about, efficiency and stuff like that, but really, if we take a really broad view of the goal of a financial market, what we think in theoretically or within academia, we think the main importance of a financial market is that they match people who need money or entities that need capital with people that have capital or entities that have capital. Right? And so we can think about, say, for instance, in a stock market, what we are really doing is matching investors who want to own pieces of companies, shares of companies, with companies who need capital to make their investments going forward. And so we can think about a bond market as people who want to loan, have capital, and they're willing to loan money to companies or governments. And we're trying to match them with the companies that require a loan to make investments or do whatever. Same thing with real estate, commodity, whatever. We are trying to match those with capital to those that need capital. And that overarching goal is true for all financial markets, right? Even something crazy like the tulip market in the Netherlands, which is where, the Netherlands is the main grower of tulips in the world. They have all different kinds of tulips, and they have this really interesting, unique tulip market where tulips are bought and sold. So that is the farmers that are growing tulips need capital to continue their farming operations. And the people that are buying tulips have capital and they need tulips, and we match them together, right? Now, taking that, if we're driving down the goal of financial markets, then we obviously, what we're trying to accomplish when we think about financial markets is we want to make these markets more efficient. This matching procedure should be as efficient and seamless as possible. And over time, that has become true, but it isn't always true in every market, and not every market is as efficient or well-performing as others. So the equity markets, which are the biggest, largest financial markets for the most part in the world, and there are equity markets all over the world. There's, the ones that we've talked about in the US, the New York Stock Exchange, the NASDAQ, but there are, plenty in Europe. The biggest ones in Europe are probably the German exchange and the London exchange and the one in Amsterdam. There are big exchanges in Asia, in Tokyo, in Singapore, in Shanghai, Hong Kong. there are big exchanges in Africa and South America. And so when we think about these equity markets, we think that they are, broadly speaking, pretty efficient. They do a really good job of matching people who have capital with people who need capital. But that hasn't always been the case, right? If you think about, if we go back in history and you think about, maybe the importance of a financial market in terms of efficiently matching something, if you want to start a business and there wasn't a centralized exchange where you could find people willing to provide capital for your business, the only way that you could do it is to wander around, call everybody you knew, hit up your friends and family, hit up strangers and just ask them to give you capital, pitch your business and say, hey, I need funding. Are you willing to give it? And that means that the ability for you to find people with willing capital is really limited, because you're limited to potentially your geographic area, to your own personal contacts. In days before, easy access of phone and stuff, I mean, you may be limited to just the people in your town or whatever. And so having a big, centralized, internationally available exchange means that companies that require capital can find people with available capital that they may never have been able to find before. We could match with investors in Asia or Africa or South America willing to provide capital for a business that they may never even physically see or participate with or see have a potential to buy the product or anything like that. Right? So this centralized exchange is a new and more efficient way to achieve this matching than has ever been possible before. And the equity markets have done a good job, but they're still not perfect, not by any means. We still see cases of inefficient operations in equity markets, and new types of equity markets designed to address the inefficiencies in this matching procedure are popping up all the time. There's an article in the Wall Street Journal just this very week about what are called block trades, which is when big institutional investors like pension funds or 401ks trade large stakes in companies. So they might own 10% of Apple, and they want to rebalance their portfolio, meaning they want to, not own 10% of Apple, they want to own 5%, move that money into some other industry or some other firm to help, balance their portfolio a little better. When you trade a large tract of stock like that, a huge holding like that, it can move the market, right? If regular everyday investors see that some giant investor is trying to sell a ton of stock, that can be viewed as a negative signal, which will move the price down, which will hurt the seller. So what typically happens is that the seller tries to go through a large investment bank. They sell their stake to the bank, who then has the ability and the requisite contacts to parcel out that huge chunk of stock to lots of different investors without moving the market. And what the Wall Street Journal investigative reporters noticed is that these block trades, when they get reported, the stock's price had fallen significantly in about 60% of these block trades before the trade was completed between the bank and the institutional investor. Meaning, there is some suggestive evidence that the bank, having this knowledge that the investor is trying to sell their stock, but the transaction not being completed yet, the bank disseminated some of that knowledge, allowing other investors to jump in ahead and capture some of the gains from this trade. That effect was significant enough that it was several $1 million per trade that these institutional investors were losing. Right. So the point of this story is that there is an inefficiency there in this matching procedure, in that the institutional investors being unable to match with the people who want those shares and having to go through an intermediary in order to match creates a potential inefficiency where someone else can jump in front of them and capture some of the gains from trade. So there are new markets being developed all the time where some of these inefficiencies are trying to be addressed, where there's a relatively new equity market that removes any middlemen or any middle companies, any banks or any intermediaries from the process altogether, so that buyers and sellers are matched directly. that addresses some of those inefficiencies. Right? Some of the other markets are even less efficient. We talked about the bond market and how inefficient that was when we covered bonds in Chapter 7. The bond market doesn't have a centralized exchange at all. It's an over-the-counter market. The only way to buy and sell bonds is to call up people you know that are also buying and selling bonds and see if they want to buy the bonds that you want to sell, and vice versa. And that's a horribly inefficient way to match. Again, because you're limiting your pool of potential investors to only the people that you know. And so that means that the bond market's considerably smaller, hundreds of thousands of traders, as opposed to equity markets, millions and millions of people buy and sell equities, possibly billions of people buy and sell equities, right? So that market is huge. And the other markets, commodity markets and stuff have their own inefficiencies to deal with. But broadly speaking, that's the goal of a financial market. We want to match people who have capital with people who need it, right? Now, some of the individual goals may then, benefit from that. The people who have capital to provide are looking to grow that capital. They can easily find a partner to do that on the financial market. And the people that need capital can easily find that capital at a good price because they can look at a bigger potential supply in those markets.